And hello, everyone. It's a pleasure to spend time with you all today. I want to, next slide, please. I want to cover off on three specific topics with you all today. First, COVID-19, our response from a major modeling standpoint, and what we're doing to mitigate losses from COVID forbearances. But second, I'll talk about the need for us to make our models more robust and our model processes more resilient. This is something that we learned critically coming out of the pandemic. And then finally, I'll talk about how we're advancing things that are working really well, including natural language processing, image processing, and the models behind ACE and AIM. Next slide, please. So our major models continue to perform as expected during the pandemic, sometimes with overlays. But they allowed us to continue to fulfill our mission of providing a stability, liquidity, and affordability to the market. Certainly, the rate of forbearances tended to be far less than we originally expected, and we've been dialing back our overlays ever since. From January 2020 to March 2021, roughly 770,000 loans went into forbearance, and of those, about 50% either self-cured or sold, and about 41% went into a payment deferral mod, a new type of mod that we stood up specifically during the pandemic. Next slide, please. So one of the things we did to deal with COVID forbearances is we built a new tool that analyzes forbearance activity in the portfolio. And what this really does that's critically important is it tracks loans as they exit forbearance states and then figure out how they perform going forward. The second thing that we did is we developed a new kind of mod called a payment deferral mod. The payment deferral mod, instead of sort of making the borrower catch up quickly, it took the lump sum payment and put it at the end of the mortgage. So if the borrower has the capacity, they can just return and make the same kind of mortgage payments that they were used to doing. I should state that, we haven't had very many defaults at all recently because of the foreclosure moratorium and the REO moratoriums. But the real canary in the coal mine still is how will these COVID forbearances play out over time as forbearance policies end and as the foreclosure and REO moratorium get lifted. But again, they're far less than we originally thought they were going to be. Next slide, please. So now I want to talk about the need for us to build models that are more robust and model processes that are more resilient. So next slide. Here's a couple quotes. One's from EY, and it points out something that's really amazing when you think about it, is that our major models are really heavily regulated. 3 lines of defense, the regulator oversees them, et cetera, et cetera. With that degree of regulation, it's intended to make sure that the models are designed to meet the business need. But then the key question is, how come they failed so quickly after a couple of days when COVID struck? The McKinsey quote really talks about both the need to do short-term adjustments, but also the need to build model processes that are more resilient. So I think I want to point out that these are industry-wide problems, not just Freddie Mac problems. And maybe we should focus on building models that aren't quite as heavily optimized for back behavior, but designed so that they will forecast better going forward. We certainly have heavy ongoing monitoring requirements around our models, but the question is, what happens if the alerts fire, and even if you put them on yellow status? Well, then you could start model redevelopment exercises and the like, but that takes a long time. What we really want is the ability to produce reliable forecasts immediately following a major structural break. Next slide. So the thing is that some of our major models, as I mentioned, broke down as the pandemic took hold. Conventional data sources became obsolete. Those with macro variables did the worst by far. For example, our house price forecasting model did not do a very good job. But fortunately, we did learn some really cool lessons, and that is that some models, especially those that relied heavily on machine learning, tended to perform very nicely throughout the crisis. So that's something for us to build on. And it's not going to be the case that adding a lot of macro models to some of these models that failed is actually going to be the source of the cure. What we need to do is think about building either a variety of models or use different kinds of modeling techniques. Next slide, please. So here's a simple example. So what you would expect to have happened historically is the unemployment rate shot up to about 15%. GDP went down by about 20%. And historically, you would expect house price appreciation to have declined. But that's not what happened at all. Unemployment went up, GDP went down, but house price appreciation continued to go up, and to go up rather robustly. And so those major key relationships among the macro variables just simply collapsed, and were no longer reliable. So the thing is, you can try by adding new kinds of data, and we did by looking at sort of hotel reservations, traffic patterns, other kinds of data that you can bring to bear. You can look at more fundamental relationships. So our house price forecasting model is a two-stage model. In the first stage, you get the long-run trend as a function of things like population growth, real disposable income, and the like. And the short-term fluctuations are determined by unemployment, GDP, and the like. What we've learned is you shouldn't use proxies for things that you care about. Go for the thing that matters, in this case, real disposable income, because what happened with the fiscal stimulus and the CARES Act, there was such an inflow of money from the government that people's real disposable income actually rose throughout the period. So if you knew that real disposable income was going to continue to rise, then you would not have expected house prices to decline. You would have said there would be no downward pressure on house prices. Next slide, please. So one of the cool things about machine learning models compared to standard statistical models is the fact that they have a whole lot more features or variables included in them, typically hundreds. And we use techniques called regularization that takes those variables and downweights them all. Compare that to the bottom part of this graph. That's a traditional statistical model that might have 15 to 20 variables in it. Well, if 2 or 3 of those variables, sort of the relationships break down, that whole model is now off the track. That's not the case with the machine learning models. If a couple of 100 or 200 attributes or features break down, the whole model can continue to perform quite nicely. Next slide, please. One of the challenges with machine learning is, though, that the models are more complex and they are more difficult to interpret. However, they are far and away more accurate. And they're more accurate because they do a better job of capturing things like nonlinearities and interaction terms that standard statistical models do a poor job of. But what you need to do then, if you're going to build these more sophisticated models so that they're digestible and that the business people will sign up and use them, you have to figure out how to overcome areas of model risk management that are amplified, where the risks are amplified by using these more modern techniques. We use Shapley values, to help make the models more explainable. You can do it with challenger models. There's a variety of techniques that you can use to help make the models more understandable to folks, to our business partners. I should say that the regulators have not issued specific guidance around AI and ML when it comes to the highly regulated financial space yet, but they recently did issue an RFI, and Governor Brainerd at the Fed said some things in a speech which are signaling that regulations on the way. So hopefully the things that we're doing will already conform with the regulatory guidance that we'll have for these more modern methods. We have a separate corporate policy. We have standards. We have ethical principles that need to be adhered to, and other controls in place to make sure that we're addressing bias, explainability, all those areas where these new techniques amplify areas of model risk. Next slide, please. So some basic definitions here. When you are built, robustness means the ability of a system to avoid failure. And resiliency is the ability to recover from failure once it occurs. Both these concepts are really important, but both are hardly ever discussed in the financial institution space and hardly ever in model risk management discussions. So what we've been doing is we've been tapping into literature from other areas. Defense is a perfect example, right? If you have forces in the field, first of all, you don't want their equipment to fail. That would be, if it fails, to limit failure, you would like the equipment to be robust. But if it does fail, you want it to be resilient so that you can recover really quickly, because if you don't, people die. So we're borrowing a lot of practices from other industries and bringing it into our space so that we can also have models that are more robust and resilient. For robustness, on the right-hand side here, you can use things like adversarial samples, synthetic data, and the like. For resilience, one of the things you can do is, instead of just relying on one model, maybe you have a suite of models that are available, and depending upon the state of the world that you find yourself in, you would give that model a heavier weight relative to the other models in the suite. Next slide, please. So why resiliency is so important, I believe, is that most of the things that are going to hit you really hard are things that are completely unanticipated. Having those multiple dials that are available to you, because you've got a variety of models, you could say, well, now I've got one that has a high inflation component into it, and I know how the features behave in that model. I expect if we expect inflation to go up, then we could say we want to weight that kind of model, or we want to dial the parameters more to be like the parameters that are in that specific model, right? A perfect example is our loan product advisor tool, which is our front-end decisioning tool. The credit attributes were all just great coming into that model, but because of the CARES Act, they gave forbearances to auto loans, student loans, other kinds of loans, credit cards, etc. Those people were not making their payments, but were still being reported as current. We needed a process to be able to take that data in and still make sense of it in a way that enabled us to make smart credit risk decisions. So next slide, please. So let's talk about a few things that we're advancing that work really well. Next slide. So, and one more if you could. So I'm going to talk about a couple techniques now. Both are different kinds of neural networks. And one type of neural network is called a recurrent neural network. Recurrent neural networks do a really great job when it comes to text and voice. Convolutional neural nets, in contrast, do a really great job when it comes to pictures, making sense of pictures. So what I want to show you, Freddie Mac is blessed with a wealth of data. It's just, for people like me, you're a kid in a candy store. But a lot of that data is unstructured, which means you have to have tools and techniques to extract insights from that data so that you can create business value from it. And what I'm going to give you a brief overview is how we're doing that exactly. So if you look at the business questions that people might have come to us with, one is California passed a new law about accessory dwelling units. It's also an important area for affordable. Another group came to us and wanted to know about, a discriminatory language in our BPO reports that we receive. And finally, the list could go on and on. But when you deal with big data, and we are talking big data, terabytes of data, lots and lots of data, the three V's are what you can worry about. One is the volume of data. The two is the variety of data, and the third is the velocity of data. So volume is, like I said, an enormous amount. This is big data. This is cloud computing. There's a lot of data involved here. The variety is you could receive it as PDFs, Excel files, and a whole variety of different ways. And from a velocity standpoint, it could be real time. It could be daily, weekly, monthly, quarterly, whatever. And you've got to put all that data together as described on the far right plank into a cloud environment so that you can attack it and extract business value from it. Next slide, please. So the trick is that what we're moving towards, and I don't want to oversell this, but we're definitely moving towards something called deep learning. Deep learning are types of neural nets where you don't even need to label the outcomes. The neural net itself can determine the outcome of interest once you give it the optimization routine. We're moving in that direction, but still in our problems currently that we're using these techniques on, we still have a lot of humans providing a lot of the labels. So this is an accessory dwelling unit. That's not an accessory dwelling unit. These are terms that we would consider derogatory. These other terms are not derogatory, etc. So that takes a lot of human time to do that. But what we want to gravitate towards are what's a technique called real deep learning, where you don't need to spend nearly as much time labeling the data. One of the beautiful things about this is speed, and the performance of these models is even better than other types of neural nets. Next slide, please. So let's take a typical problem that we've got here. You've got, you're interested in maybe accessory dwelling units. And so the first thing you have to do is realize, how is this data coming to me? Is it coming to me in PDF? Is it coming to me in an appraisal report? How am I getting the data? Then you have to identify where's the text in that document. And then you figure out the sentence structure. Where does each sentence begin? Where does it end? Then tokenizers. You get rid of all the ands, ahs, thus, buts, things that really don't add much content. And then the name finder gets rid of proper names and the like. But to the far right of this slide, what we've done is we converted human language, which has its own logic associated with it, to computer code. Something that a computer can interpret and make sense of. That's the far right panel. So next slide, please. So now that you've gotten that computer code, you can sort of take that raw data, you parse and you clean it, you make sure you've got the address right, you develop the training data, you get it in a way that's the machine can read it, then you apply your recurrent neural network framework to it, and out comes the information that you really desire. This was an accessory dwelling unit, that's not an accessory dwelling unit, that in fact is an apartment, etc. They're the things that you want that you can use for credit policy purposes. You can use it for QC. It helps affordable. You can track where throughout the country where there's a lot more accessory dwelling units, and it is geographically very heterogeneous. And the other thing then is, though, it creates features or variables that then you can put into your models. Next slide, please. Now, what's even more exciting is image processing. And image processing occurs via something called convolutional neural nets. And I'm not gonna get techy here. But you get a picture, right? And so you got this picture. You're gonna rotate it in different directions. You're going to neutralize it so you can look at the pixels and everything else. A convolution in math is just an operator, is all it is, that sort of mushes things, defines how you're going to combine things, and it's got Fourier transforms and everything else. But again, don't worry about any of that. All that matters is there's math behind all this that can take those pictures on the left-hand side, take it through a process to get you the information that you care about on the right-hand side. What's the room type? What's the condition of that room, etc., etc. Next slide, please. And so here's what you get. You get pictures in a whole bunch of different frameworks, PDFs, Word documents, you name it. So then you got to parse it out, and you got to label what the documents are. You've got to set the address for the property. You have to extract the pictures and then locate the images and extract them, and then do that conversion to numbers that computers can interpret. But then again, once you do that, then you can apply your convolutional neural net, and out of that comes the information about the individual rooms, and not only that, the overall assessment of the condition of the property. And this is all just taken from pictures. It could have been pictures from an appraisal report. It could have been MLS pictures. It could have been pictures from somebody that did a home inspection. These pictures can come from a whole variety of places, but you can extract those values. And believe me, the condition of the property has a lot to say with how that property is going to be valued. Okay, so now let me turn and talk to you about something else that's worked really well, which are the models that power ACE and AIM. ACE is our automated collateral evaluation engine, and it's powered primarily by HVE, or Home Value Explorer, which is Freddie Mac's AVM, right? And AVM is just a computer tool that takes a bunch of data and produces an estimate of value, and in our case, a forecast standard deviation for that estimate of value, right? The outputs include just what I said, the estimate of value, the FSD, but our HVE estimates a fair market value for roughly 100 million properties across the country, and these estimates and FSDs are updated on a very regular basis. It follows our regular model governance, and it's used throughout the company for a lot of business applications. Next slide, please. So here we talked that one of the cool things about our FSD, or forecast standard deviation, is it's property specific. It's also empirically derived and statistically based. So when we say our FSD is this, and if you did testing, you would find out so many of the answers found range within plus or minus one FSD, the same way that you would interpret a standard deviation in regular statistics, right? Other AVMs give confidence scores, but they can't be really tied back to any statistical properties. We need it tied to statistical properties because we're going to use it in our downstream models, and we need those statistical properties to help us, right? Again, I said it's already used throughout the company for a variety of applications, and we invest a lot of time and money and materials to make sure that this is as accurate and precise as we need it to be. Next slide, please. So here's the performance. I'm showing you this performance chart for HVE. Typically, AVMs are determined by how precise they are by how many of their estimates of value fall within plus or minus 10% of actual sales price. So as you can see, typically it's low to mid 80s with the very, very rapid run up in home prices. It's deteriorated a little bit now so that it's in the high 70s, but it's performing quite nicely. I do want to emphasize again that HVE, the AVM, is built for credit risk management purposes. We do distribute it externally, but that's like a Stephen Covey sense. We're using that external presence so that it gets tested against other AVMs, etc. It helps sharpen our saw so that we make it as good as possible for our internal credit decisioning purposes. But while the performance is this, you could see a different AVM that says, wow, my percentage within 10% is in the low to mid 90 range. And my response to that is I can get you there too. If I'm willing to leverage recent list price information, I can get the performance to be really high. We don't want to do that because we're using it for risk purposes, and the realtor is a party to the transaction, and we don't want that party to the transaction to be able to influence the final estimate of value. So we're very careful about the data that we use, how we use the data. I would say HVE, it produces conservative estimates of value. I know that's the case. But next slide, please. Along with, our estimate of value and the FSD, since we're giving appraisal waivers, we have to perform the same basic functions that appraisers do. Appraisers inspect a property to determine its condition. They get comps and make adjustments to the comps to come up with their estimate of value, etc. So we've already said how we can estimate the value of the HVE, but now we want to know what the property condition looks like. We started out with a bunch of logic, rules, etc., that would help us determine the condition of individual properties, but we've replaced some of that logic with machine learning models, and these models we built them using a platform called Data Robot. It's out there in the market, and we're public about. We use Data Robot. We also have other machine learning platforms, and it's in the cloud. We researched it, developed it, and deployed it entirely in the cloud, and it performs remarkably well, especially when you combine it with all the other ACE rules. We have rules around you have to be an LPA accept. You have to pass the valuation criteria. You have to pass the CCE criteria, saying that we think the property is in good condition, etc. When you pass all these criteria, we have found, and we independently quality control this, that CCE is doing a remarkable job at identifying the condition of properties. So when we put all these together, only when we're comfortable that we're getting positive reads from all of these do we offer an appraisal waiver to our clients. And next slide, please. The really cool thing about it and the pandemic is it also gave us the chance to do some basic research. Our chief economist's office did a study where they compared the performance of AVMs relative to appraisals in a traditional default type model where all the other risk features are held constant. The only differences between the two types of loans are some were undertaken with an AVM and the others were originated using an appraisal. And if you go to the bottom of this slide, what you see is, you can see the data was from 2000 to 2017, et cetera. So it spans, improvements in the appraisal process after the Great Recession. But still, the takeaway is there's still warts with the current appraisal process. It has improved a lot. But on balance, the AVMs outperform and always do at least as well, if not outperform, loans originated with traditional appraisals. Next slide. What we also did was we wanted to see how loans originated with ACE performed relative to similarly situated loans that had used an appraisal. So what we did was we got together all the loans, matched out the ones that were ACE eligible, controlled for all the risk characteristics, and then said, well, how did the ones that compared that took the waiver versus the ones that didn't take the waiver and got an appraisal? What's the relevant comparison of those two? And the bottom line are the green numbers on this page, and that they're all green is an indication that in each instance, the waiver loans are performing superior to the ones that had a traditional appraisal. And I can tell you that thank goodness for the waiver programs that we have and our sister across the river had, and some alternatives that I'll talk about in just a second, because without these, the mortgage market would have seized, right? People did not want appraisers coming in their homes, and appraisers did not want to go in people's homes. Having said that, however, we still got more submissions to the Uniform Collateral Portal last year than ever. So even though our waiver programs ramped up to close to 50% of the originations, we were still getting massive amounts of appraisals submitted to the portal on a regular basis. So again, that goes back to we're not trying to find things that would replace or get rid of the appraiser. What we're trying to do is use the best valuation technique for that specific loan and that specific borrower combination. Next slide, please. So this is we have this on a website for our appraisers to look at, and that just gives them comfort that, we're not trying to put you guys out of job. We're just trying to get the right valuation for the right type of loan. Next slide, please. And finally, COVID offered us the opportunity to have a couple natural experiments. We were able to use desktop appraisals, and we were able to use drive-bys. And so, why we did this, we had a lot of rules around where they could be offered, how they could be used, etc. The bottom line is that combined, these two had less than 4% of the loans that we originated during 2020, and but enough to let us tease out to see how these loans performed relative to those that had full appraisals. So again, really exciting stuff here in the sense that HVE is an ensemble that leverages machine learning. CCE definitely leverages machine learning, built on a machine learning platform. But we also are being prudent with where in the risk space or the risk buckets that we're offering eligibility to these alternatives. So we're not taking them up to the super risky loans. We're still having all those done with an appraisal. And if the FSDs are too high so that we don't have confidence in our estimates of value, then we pass it to an appraiser and say, the model's not going to do a good job with this specific property. Okay, next slide, please. Now let's talk about the models that power AIM. AIM is our income and asset and income modeler. It enables Freddie Mac to systematically assess borrower capacity and their asset positions. What it allows us to do is receive data directly from the source, rather than our lenders going and get that data, maybe fat fingering things and not calculating income correctly and stuff like that. By us going to get the data directly from the third party, we can ensure that the loan is being manufactured in exactly the direction we want. And it enables 100% upfront QC. So instead of the small percentage of loans that we would QC traditionally and sort of see if they calculated income correctly, this is enabling us to do 100% of QC for all those loans that take the AIM functionality. Again, it removes subjectivity and manual errors, and it helps reduce fraud. Next slide, please. So these are just some of the offerings that are broad in the ACE space right now. I'm not going to read through them all, but you can see that, in some cases, they're getting asset data from third-party providers such as Foreign Free, Finicity, Blend, and the like. But of all the applications that we've gotten near the end of last year, only about 7% of those use this feature. AIM for income is, we get the income from a provider like Equifax. Again, this is nothing different than what lenders do today, except we're doing it in an automated way for them. The next one down is AIM for income. We're able to go to payroll providers directly rather than get that information from Equifax through a set of vendors. And finally, we have a component for AIM for self-employed borrowers, which allows us to work with vendors who can take tax returns and apply OCR to it to extract the relevant information off that tax return so that we can calculate income exactly the way we want to calculate it. So AIM leverages a bunch of data, including account, asset account and transaction data, tax return data, employer data. It assesses whether there's sufficient assets for the transaction, large deposits that may have come in that we want to know where they came from, and income, whether it be payroll, self-employed, or whatever. So these it's really nice functionalities, and our clients love it because it saves them a lot of time and energy, but we love it because it ensures that loan's being manufactured according to our specification. Next slide, please. And then we're continuing to gain momentum with the AIM offerings in the market. Collectively, across all those broad offerings that I talked about, at the end of 2020, only 18% of the apps took advantage of at least just one of those AIM capabilities. We're hoping to grow that to 25% at the end of this year by bringing new vendors on and the like. For example, we recently brought on CoreLogic and LoanCraft in the self-employment offering space, and we'll continue to look for opportunities to do that to give our lender partners more variety as to what vendors they would like to deal with. Next slide, please. And so AIM continues to evolve. We are leveraging natural language processing, what I reviewed earlier, to make sense of bank statement data. Is this the employer? Is this the name of the employer? Does this income flow into the account? Is that regular? Is it biweekly? Is it monthly? Oh no, that large inflow there, that's not income. That's something different. So we're able to distinguish that, and ultimately, all these are used to evaluate the borrower's capacity using alternative of ways of how they manage their money, but their capacity to afford the loan. Because our goal at the end of the day is to get people in homes that they can afford and keep, right? So it's not just the affordable piece, it's a risk management piece, right? It does us no good at all to get somebody in a home and then 6 months, a year or two later, we feel like that person did not belong in that house. They didn't have the capacity to make their payments. But it's also setting the stage for something that's going to be really exciting in the mortgage space, which is getting away from the reliance on front and back end ratios. Like in this case, a debt to income ratio. If you think about it, that's sort of a crazy way that we underwrite loans in the mortgage space. What you should care about is net income, not gross income, right? And so you want to know for that specific borrower, what health insurance program do they belong to and how much gets extracted from their pay for that? Do they have alimony payments? Is their job regular? And then what's the tax state law? What's state taxes that they have to pay? All those things get you from that gross number that they get paid down to the net income, which shows you actually how much residual income they have to pay their mortgage. So we think this is really exciting stuff, and we're going to continue to advance these capabilities. So let me summarize then. So to sum up, let me just say that I talked with you about three things today. First, I gave you insight into COVID and how it's affecting our major models, some of which needed overlays, but some of which continue to perform very nicely through the pandemic, and the actions that we're taking to mitigate losses from forbearances as they exit forbearance state. Second, I explained why we need to make our models more robust and our model processes more resilient. To me, it's just unconscionable that when a major structural break happens, that we're running around like chickens with our heads cut off, figuring out what overlays need to be applied so that the models are going to give reasonable outputs. And again, this is an industry-wide problem. We were calling the iBanks, the money center banks, you name it. We're calling all these people just saying, what are you doing? It's like, yeah, we got a problem. We need overlays. So how we're working, there's a heavy research effort going on to say, how do we build models so that they don't fail in the first place? And then if they do fail, we can recover much more rapidly. And then finally, I gave you an overview of how we're advancing those things that continue to do really well. Natural language processing, image processing, and the models that underlie AIM and ACE. So there's a lot of excitement going on in this area, and Freddie Mac has so much data, much of it's unstructured, and we're just like at the top of that iceberg to sort of get and derive insights from that data. As we continue down this journey, we're going to be able to get more and more insights for credit policy, for modeling, for helping our clients design. We can design better solutions for our clients, etc. So I think this is really exciting, and I hope you enjoyed this overview. I thank you and enjoy the rest of Investor Day.